Hey guys, this is Danger with Today in DeFi. I'm a DeFi trader and farmer, and today we're with Cyrille from FX Protocol. And FX Protocol is a leverage trading protocol that lets you trade without liquidations. I'm really excited to find out more. So yeah, Cyrille, can you start by telling us about your background and how you got into DeFi?
Yeah, sure. Hey, thanks, Danger, for having me today. It's a real pleasure to be here. Yeah, so I'm Cyrille. I come from France and I discovered crypto in 2017 mostly. Quite a few mistakes and dropped it for a couple of months, then came back with the DeFi summer in 2020. In the meantime, I was mostly doing farming with CDeFi products such as Celsius and Nexo and so on. I thought it was DeFi, but when I discovered real DeFi in 2020 during the DeFi summer, I just fell into the rabbit hole and started farming. This thanks to a French community called DeFi France, now very involved in, and started farming and digging into DeFi protocols, designs, and so on until discovered Aladdin DAO with the first product called Concentrator and really enjoyed how the Aladdin DAO DeFi values, which is very community centric. And finally, after releasing Clever, Aladdin DAO released F of X protocol in August 23, and I just loved design and started contributing on Discord and so on. Then got onboarded as a team member like a year ago, something like. Yeah, that's basically it. I'm now
Uh,
contributing to F of X protocol and also Lagoon Finance, which is a DeFi infrastructure to create vaults, basically, and for asset managers.
Very cool. Yeah, it seems like there's a pretty good crypto scene in France. There's so many protocols there. Besides, there's FX. I think Aave, I think was originally, I guess it's like all over Europe because the founder, I think, was Swedish or something. But then there's also Mark. I think Mark is French and he was part of the early Aave team. And there's also AP Wine, which is now Spectra, is
Absolutely. Yeah.
French. Morpho is French. So there's tons of DeFi coming out of France. So I guess it's like the baguettes for the croissants,
Yeah.
just something in the water.
Yeah, probably. Or maybe the spare time, because in France we don't work a lot, so maybe it leaves us enough time to dig and DeFi and to contributing. But yeah, correct. I'd like to say there's a French in every good DeFi project. Doesn't mean every
Absolutely.
French DeFi projects are good, but there's a French guy in every DeFi project.
Cool. So yeah, I've been wanting to do this interview for a while because we've been following FX for since the beginning. So this is
Yeah.
FX Protocol V2, but I think it's been around for like over a year or two. The FX V1 has been out for a while, and
Yeah.
we really liked it because it was like this very decentralized design. Can you maybe go over FX V1 just so everyone knows the basic design of FX Protocol, like the
Sure.
stablecoin and yeah.
Yeah, sure, with pleasure. V1 was created in reaction of the USDC debate that happened in March 23 due to the Silicon Valley Bank failure. And V1, so the Aladdin DAO realized there was no reliable decentralized stablecoin at that moment. Aladdin DAO was exposed to USDC and decided to make something out of it and create a real decentralized stablecoin. At that point, the only alternative to centralized stablecoins was Liquidation LUSD. It is a very decentralized stablecoin, but the peg isn't reliable because it's fluctuating between 0.99 and 1.6 or 7, something like that. And most of the time when you need to buy it, it's 1.105. And when you need to sell it, it's 0.99. So it wasn't reliable for a DAO to hold this. And so Aladdin now came out with a very interesting design, creating F of X V1. And the way it works is very simple. It takes any yield-bearing asset and split it into either a zero volatility asset, which is a stablecoin, or a high volatility asset, which is a leverage token. So the leverage token captures the volatility which isn't distributed to the stablecoin, creating a leverage token with no liquidation risk and no funding cost. While the stable part, the stablecoin, captures the underlying yield. If you want, I can share a slide to explain how it works. So as you said, yeah, it's been live for over a year because it was launched in August 23. And it worked and it works pretty well, but it's not perfect on the leverage side. So this is why we iterated with V2 more recently.
Cool. Yeah. So if I recall, with V1, there's two assets. There's like a stable asset, and then there's the leverage asset.
Correct.
Yeah. So that's going to be FXUSD and then XST for.
Yeah, FXUSD is now only backed by V2 design, but on V1 we onboarded, since V1 works with any yield-bearing asset as collateral, we created different stablecoins and different leverage tokens because we started with Lido staked ETH in the backing, but we also onboarded restaking assets, or we also onboarded the staked CVX from Convex, for instance. And since the collaterals have different risk profiles, we created different stablecoins and different leverage tokens that users can assess their risk exposure as they want. The key from this is that it kind of fragments liquidity and offers different strategies and can be confusing for the users when they arrive on the dApp. And we fixed it with V2 as well by having only one stablecoin backed by V2.
Very cool. Could you maybe share a slide or screen and
Sure.
maybe go through the mechanism of V1 and then the strengths and maybe the weaknesses that led to V2?
Yeah, with pleasure. How is it? Let me try this. Share presentation doesn't seem to work. Let's try it with screen. And can you see it?
Yeah, definitely.
This is V1. So V1, FXUSD used to be backed by V1. So the way it works is, as I said, very simple. You can take any yield-bearing asset. In that example, it's Lido Steve. Can you also see my cursor when I show?
No.
No? Okay. So on the left, you see that's Lido Steve. You can put it into the reserve, and the protocol will either mint in V1 a stablecoin, which was FXUSD in that example, or leverage token, which was XSTEEF in that example. And the way it works is very simple. It uses a formula we call the f of x invariant. And that formula says that at all times, the value of the reserve is equal to the value of stablecoins on the market and all leverage tokens on the market. It's very simple. So now, to understand how the leverage works, we can use that example. Let's imagine there's $200 of STEEF in the reserve, $100 of FXUSD on the market, $100 of leverage tokens on the market. So in that situation, when the price of ETH raises, hopefully, by 10%, the value of the reserve goes from $200 to $220, right? The value of all FXUSD, since FXUSD is a stablecoin, stays $100. So by using the FX invariant, you can just make the difference to calculate the value, the leverage tokens. And by doing so, you end up having a value of $120. So in that situation, when ETH, so when the underlying price raised by 10%, the leverage token price raised by 20%, creating a 2x leverage. This is how V1 works. But let's try with another example. Let's imagine there's less demand on the leverage side. So with the same value in the reserve, there's $150 of FXUSD in the market and only $50 of leverage token on the market. That distribution is made by market demand. You cannot decide in V1, you cannot decide of the distribution between the stable and the leverage side. So if there's fewer demand on the leverage side, so that's that example. When the price of ETH raises by 10%, the reserve again goes to $220. The value of FXUSD is $150 because it's a stablecoin. And using the invariant, you can calculate the difference to get the value of the leverage tokens, which is now $70. So in that situation, when ETH raised by 10%, XTEEF raised by 40%, creating a 4x leverage. So you may understand that. So this is how V1 leverage works. And then I'll explain later how V2 works. So you may understand that while it delivers leverage tokens with no liquidations and no funding costs, and also delivers decentralized stablecoin with reliable tech, with great scalability, capital efficiency, and yield, because the stablecoin, when it's staked, earns the yield of the whole reserve, the leverage token has variable leverage. And the leverage level depends on market conditions and most likely on demand on leverage or stable coins. So it settled around 1.5, 1.8x leverage on V1, but there's a situation where there can be higher leverage when the market goes down than when the market is up. And that's something you don't want to happen because it creates volatility decay. The opposite could actually happen too. So having a higher leverage when the market goes up than when it goes down, but it's unpredictable. So it's a really good midterm investment tool if you don't want to bother about managing your leverage position and getting liquidated and so on. But if you want to build like more precise strategies, if you want to actually trade, it's not the best trading tool. So this is why we created V2, basically.
Cool. So it seems like it has a lot of like really cool properties. Like you've created, like it creates this decentralized stablecoin that doesn't depend on anything. And then you also have this leverage, which is like not liquidatable and there's no funding. But then the cost of that is this variable leverage, which makes it a bit hard to use for trading. So how did you guys address that in V2?
We addressed it by creating the X positions. So instead of being leverage tokens in V2, you can get leverage positions, which are NFTs. And these leverage positions also have no funding cost in most cases, and they have a minimal liquidation risk. That means liquidation can happen, but they are very unlikely. And we protect the users from liquidations thanks to a mechanism called the liquidation brake. And the liquidation brake will reduce the impact of liquidations by always putting your position back at 88% LTV so that you never reach the 95% liquidation LTV, basically. I also have a couple of slides to explain it if you want. I can share my screen again.
Yeah, that'd be great.
Sure. There we are. So this was V1, and in V2, so this is how the expositions work. So in V1, you couldn't decide of the distribution between the stable part and the leverage part. In V2, let's imagine, and V2 also brings up to 7x leverage on ETH and soon, very soon, BTC. BTC should be live next week, actually, so maybe when people watch that video, it's going to be live already. So let's imagine you're this little guy on the left and you want to take a 5x leverage on ETH. You only have $200 of ETH of whatever, but when you put your $200 into the protocol, it will convert it into wrapped ETH and put it into the reserve. But you want 5x, right? So that means you want $1,000 of ETH exposure, correct? So the protocol lacks $800. To get it, it will use a flash loan. So it will borrow $800 of ETH and put them into the reserve so that the reserve has enough backing to open your X position. So it will create your X position with the $200 value, but with the exposure of the whole reserve. And in order to repay the flash loan that has to be repaid in the same transaction, the protocol will mint FXUSD. It will mint $800 of FXUSD and sell them to repay the flash loan. So you end up having $1,000 of ETH in the reserve. You, as a user, have an X position worth $200, but with the exposure, the market exposure of the whole reserve, and there's $800 of FXUSD on the market. In V2, this is the only way to mint FXUSD. You cannot mint FXUSD independently. It's always minted as a byproduct of the leverage positions. So in that example, again, when the price of ETH raises by 10%, the value of the reserve goes to $1,100. The value of FXUSD is still $800. And using the f of x invariant, you can calculate the value of your x position, which is now $300. That means when the price of ETH raised by 10%, your x position value raised by 50%, creating a 5x leverage. This is very simple. Now let's imagine you want to take profits on your position. It's going to be the exact opposite mechanism. The protocol will do a flash loan to borrow $800 of stETH, buy FXUSD to close your X position, and get $800 of stETH from the reserve to repay the flash loan, and give you back your $300. And you're now a happy trader that made a good trade. So yeah, this is how V2 works. But you may wonder, how does the FXUSD peg behave? Because there's each time people open next positions, there's FXUSD sold on the market in order to repay the flash loan. So there's different peg mechanisms. I don't know if you want me to go deeper into that, or maybe you have a couple of questions first.
Yeah, so it sounds like this V2 is built on top of V1. So the core mechanism, if I'm understanding it, so the core mechanism, like core primitive of that invariant, is still happening under the hood. And then on top, there's this NFT, exposition NFT, which helps create these fixed leverage positions. And is there any other part of the protocol which is part of this mechanism as well, or is that a good description of this framework?
It's a little bit, you can see V2 as multiple V1 aggregated, because the main difference is that on V1, the leverage tokens are fungible. That means every token holders have the same leverage, and the leverage fluctuates with market conditions. On V2, since it's leverage positions, each user can set their own leverage from 1 to 7x, and will have individual positions backed by the FX invariant, correct? But this is slightly different from the one.
Okay, interesting, cool. Yeah, it would be cool to hear about the peg then, because that seems like it might be part of this mechanism.
Yeah, sure. It's very important. Like when you the ambition of f of x is to create a real sustainable and reliable decentralized stablecoin, because today there's only 0.3% of the $230 billion of stablecoins which are truly decentralized. All the rest is centralized or exposed to USDC or UST bills. So to do so, it's very important for users to trust the peg and understand how FXUSD stay pegged. And actually, we've had a pretty nice growth because V2 was launched 2 months ago and FXUSD grew pretty well in the charts. I didn't check today, but last time I checked, it was something like the 30th stablecoin on Ethereum, which is great for a decentralized stablecoin. But yeah, let me explain how the peg mechanism works. Yeah, let me share again. Screen. Yeah, here we are. There's different peg mechanisms. The first one is the stability pool. The stability pool is a yield strategy in which you can deposit either FXUSD or USDC. When you deposit your stablecoins into the stability pool, you will earn different sources of yield. The first one is the exposition fees. So the expositions are the leverage positions. As I told you, there's no funding cost, but there's just an opening fee and a closing fee. Opening fee is 0.3%, closing fee is 0.1%. And you can hold your position as long as you want. There's no funding cost in most cases. The opening and closing fees are mostly distributed to the stability pool. That means when there's volatility, when there's a volume, there's high real yield distributed to the stability pool. Then the collateral yields are also distributed to that stable strategy. Since everything is collateralized by Lido stETH, which earns 2.8% APR, all the yield is distributed to that specific pool. And then there's FXN emission, which is our governance token, which are also distributed to the stability pool. So it delivers quite some attractive, stable yield, which is mostly made of organic yield. This stability pool attracts FXUSD and USDC, and it will act as a peg keeper. That means each time FXUSD is traded below 0.997, the stability pool will use its USDC to arb the peg and buy FXUSD. And saying each time FXUSD is traded below one, above one, sorry, it will sell FXUSD for USDC, thus arbing the peg. And right now there's something like $40 million in the stability pool, thus making the peg very reliable. If that's not enough, there's another mechanism, because in DeFi you always have to anticipate anything that can happen and have different backstop mechanisms. So the second mechanism is what I call the depeg mode. If the EMA in 42 minutes of FXUSD goes below 0.998, you cannot open any more X positions. That means you cannot put any more selling pressure on FXUSD. And there's, in that specific condition, a funding applied to the X position. So the X position end up buying what it would cost them to borrow USDC to create the same position on Aave. Actually, they cannot create this position on Aave because Aave cannot go above 5x on ETH. But if they were able to, they would pay a borrowing cost in USDC, and that specific cost is temporarily applied to the X positions and distributed to the stability pool in order to attract more USDC supply, helping to restore the peg quickly. So that's very temporary. And finally, if that's not enough, you can always redeem one FXUSD for $1 worth of Rax ETH. There is a 0.5% redeeming fee if you do, and so it creates a hard floor peg of 0.995 for FXUSD. But I don't think there ever was any redemption because the other mechanisms protect the peg enough.
Yeah, that's awesome. I like this. So you have a mechanism for normal market conditions, severe market conditions, and you also have a backup mechanism. And I like this a lot. I like my stablecoin stable, so that's pretty.
Yeah, we all do. We all do. we all do. All made mistakes with algorithmic stablecoins before, or even most lately centralized stablecoins that end up depegging of 14%, something like that, because of team decisions. That's something we don't want to see, and we don't want people to rely on the human decisions when it's about having stability. So this is why Apex protocol was built in the first place.
Yeah, I really like that. Like, it feels like there's very few like cypherpunk DeFi protocols left, and it's really interesting that you guys are focused on creating this decentralized stablecoin first, and then this kind of leverage protocol rose up around it, and it's actually quite cool. So
yeah, it is. It started as a stablecoin ID, and in the end, in V2, the stablecoin is the byproduct of the leverage product. But we also like to bring innovative solutions for leverage to make it less stressful, less dangerous. And every Aladdin DAO product has been built with a set and forget approach. Concentrator is a set and forget yield protocol. Clever is a set and forget CVX maxi, I'd say, protocol. And F of X is a set and forget leverage protocol and stable farming protocol.
very cool. Cool. So we've talked about the mechanism and the theory. Could you walk us through like the UI? Because I like how the FX V2 UI is almost like a real, just a regular exchange. So it's much easier.
It is. Yeah, it is. Yeah, you're right. We really wanted to make it easier for traders to use F of X. So yeah, I can show you, and remind me to explain how the liquidation prediction mechanism works too, because I think it's a very important topic for users to understand. Let me share my screen again. Yeah, there it is. So this is the landing page when you go on fx.origin.club. And so you can basically do two things: earn USD yield with the stability pool, or trade with liquidation protected leverage. Once you click or launch the protocol, you will find a very similar to any perp interface. So today you can only trade on ETH, but very soon you'll be able to get leverage on BTC as well. And the way it works is very simple. You can either open a position or close it. For right now, you can only long the assets. Short positions will come in due time. but right now you can only long. I don't know which wallet I'm connected with. I did a couple of others with that one. The way it works is very simple. You can come with USDC, ETH, or any other stablecoin, any different stablecoin. You put the value of your what you like to know. You set the leverage, and then you can simply hit the preview button. And if you're okay with the settings, like for opening that, how much leverage did it set? 3x leverage, you only pay on 2 ETH, you only pay $34. And then 0.1% when closing, and that's all. And what you'll see is you see your liquidation break line. That means the liquidation break is the price at which the liquidation break mechanism will trigger to protect your position from hard liquidation. And maybe I can dive a little deeper in that later. So as you can see, it's very similar to any perp protocol. And once opened, you will see your position displayed here on the screen. You can track it, basically.
Very cool.
Then if you want to earn yield, you can go to the earn section and see the different strategies. So right now the stability pool has $40 million and earns around 12% APR. This is probably the lowest it's been, but you know how the market is now. Like I think like USDC and AVE is something like 3% right now. ETH is something like 4 or 5. So we've always been very competitive to compare with the other strategies. And the interesting part is that it's mostly organic. As you can see, the current APR is around 12%, and 11.35% is made of wrapped ETH. The rest is made of FXN. That means most of the yield is purely real yield, organic real yield, and you're earning wrapped ETH with your stablecoins. That means if you're bullish on ETH, your yield may end up being way higher than that if ETH finally recovers. Yeah, this is how it works. And by the way, if you guys are interested, you should use the Today in DeFi ref link because it gives you extra APR while also helping Today in DeFi work. So it's a real win referral program. You can also add the referral code hitting the earn extra APR button here. And it's a win referral program because it just gives you extra yield and gives extra yield to the referral as well. So there's no point of not adding a referral code to your account. And once you follow the link, there's just a transaction to sign. There's no gas fee to do so, just a transaction to sign to add the referral to your account, basically. So yeah, that's the UI. Pretty simple, I guess. And that's it.
Cool. Yeah, that's great. I really like this UI. Yeah, can we go back to that UI? I noticed that I really like that the APR for the stability pool is like organic. That's 11% APR on USD is incredible. And then below that, I see there's also a curve pool. So are there other farming opportunities as well?
Yeah, absolutely. So the curve pool is mostly earning FXN emissions. So FXN is our governance token, and it's also a revenue sharing token. So it captures portion of the protocol's revenue. And so if you'd rather farm FXN, then you can go to that strategy. It's a curve pool, and that's the curve pool where all the FX USD trades go. So it's a very efficient curve. Actually, it's a very efficient pool. Actually, most of the time has over 100% utilization ratio because every X position opening and closing goes through that specific pool. So you can go on Curve and deposit liquidity there. I don't think you see the tab I just opened, but you can just deposit liquidity on Curve and then stake your Curve LP on f of X or on Convex, by the way. It's true for both strategies. Since FX protocol is one of the 4 Convex integrated protocols, you can earn boosted yield on Convex. Since FXN price is pretty low right now, the boost isn't very impactful, so it's as you want. You can deposit on Convex or directly into the FX gauge.
Very cool. So there's like pretty good yield and you can on stable coins on FX. Cool.
Yeah.
And you mentioned that there's an interesting like liquidation protection mechanism.
Yeah.
Yeah. Can you talk about the liquidation break? So that's rebalancing your position when it gets close to like lower in health factor or
Yeah, that's it. Each time your exposition crosses 88% LTV, the liquidation break mechanism will put your exposition back at 88% LTV, thus slightly reducing your leverage so that you never reach 95% liquidation LTV. If the liquidation break ever fails, then you could get liquidated at 95% LTV to protect the stablecoin. It's worth mentioning that 95% LTV liquidation in DeFi is unique. Most of the time you get liquidated around between 80 and 90% LTV. But we avoid that in most cases avoid that thanks to the rebalancing mechanism. So let me explain how it works. There's a very nice tool to visualize this made by a community member that I'd like to thank. He's called Dobias, and he created that awesome tool to understand how it works. Let me share my screen again. This is it. So on that screen, you can simulate an exposition performance with the price of ETH. So let's imagine you open a 10K position, ETH worth $2,000 with a 4x leverage. The blue line shows the price of ETH. The yellow line shows the rebalancing line, the liquidation break threshold I shown you on the UI earlier. And the red line shows the liquidation line. So that's the 95% LTV, and the yellow line is the 88% LTV. So let's simulate a downtrend on ETH to see how the liquidation break and the liquidation line behave. So I hit the play button, so you can see the price of ETH decreases, and you see your P&L going down because you're making a bad trade, basically because you're longing ETH and ETH price goes down. We're about to hit the liquidation break. And as you can see, when you hit the liquidation break, I'm going to hit pause to explain what's going on. Your exposition gets rebalanced to put it back at 88% LTV. So that means your position is stick to 88% LTV. But by doing so, the 95% LTV price goes down as well. That means you're always keeping that margin to avoid reaching the hard liquidation price. That means if the price of ETH recovers, you keep the maximal exposure to benefit from a price recovery, basically. You just got partly liquidated to protect you from a hard liquidation, and you can recover with the price. So let's get back to 2000. No. Yes. Yeah. To a bit. Yeah. And so you see, you took some leverage, so you still lost a little bit in value. But if the price keep recovering, you can even be in profit, basically. Because if you had been hard liquidated, you would have lost way more, basically. On any other leverage tool, you would have been liquidated more and would have lost way more on your trade and wouldn't have benefited from the price recovery. So this is basically how it works. So it's always better to not hit the rebalancing line. But if you do, it's way less harmful than on any other leverage product, basically.
Yeah, this is why this liquidation break is actually why I'm interviewing you, because I saw anyone trading ETH or looking at the markets knows that ETH has been down only recently, and FX protocol has actually been working. So I've been like looking at the TVL, especially in ETH terms, like it's doing quite well. So from what I can tell, the liquidation break has been working, preventing people from getting liquidated. And that's super cool. Because if you're doing leverage trading, you're always confident going in, but then the market's really hard to predict. So I feel like stuff like this is super cool.
It is. Yeah, to be transparent, there was one incident in the early days of the protocol when, like early February, there was a massive liquidations on the market, if you recall. And the protocol didn't have enough keepers at that point. So some rebalancing failed and some positions got liquidated. I'd like to be transparent on that. But since the market also saw some crazy liquidations again, but it's now fixed because we onboarded way more keepers. We added more on our own as well. And every liquidation event on the market protected. In every latest liquidation event, our user got protected and rebalancing liquidation brake mechanism worked perfectly. There was no liquidations on FFX.
Yeah, I saw that. There's definitely been some liquidations in the overall market, but I saw that FX protocol has been quite stable. So that's pretty awesome. Yeah.
Perfectly. And FXUSD remained perfectly pegged at all times. So yeah, it works. It works very well. And we see people being very confident in the mechanism because we see many people opening more X positions. Because basically, since there's no funding cost, if you're long-term bull on ETH, we're hitting some pretty interesting prices right now. So it's worth opening a position if you think ETH at some point will make a new ATH or even recover from the latest drops.
For sure. I think that also makes sense because for most people, I think if they can improve their trading just by lengthening their time horizon, if they're looking at trading maybe on a weekly or at least daily time frame or on holding positions longer, usually they'll have a higher success rate. And if they can do that without liquidations, then they can really improve the chances of their success. So that's pretty cool.
It's a good way of seeing it is that since the liquidation break is less harmful than actual hard liquidations, you don't have to be as precise. You don't have to time the market as perfectly as on an other product, because if ever the market reaches your liquidation break, you won't lose too much, basically. Obviously, if the market, if you really do a very bad trade and the market keeps dropping, then obviously you will lose money because you're doing a bad trade, basically. But yeah.
Very cool. And do you guys have any upcoming like features or campaigns? I saw that you mentioned that there's going to be Bitcoin coming soon, which should be pretty cool.
Yeah, there's a lot going on. So yeah, Bitcoin is coming, and this is awesome because we've had some pretty nice growth despite the ETH price action lately, and this is awesome. But having BTC will make the protocol less reliable on ETH price action. So this is really great, and this is coming next week. We also are bringing the tokenized stability pool under the ticker FXSave. So this is going to be a yield-bearing stablecoin backed by the yield strategy I showed you earlier. This is going to bring very interesting composability on FOS because FXSave is going to be a great collateral to loop, for instance. It's also going to be a great asset to put into yield trading platforms such as Spectra, you mentioned earlier. And this is going to be supported day one. There's also great stuff coming, so potentially 10x leverage on ETH, short positions, limit orders to even make a better trader experience, and finally base launch. So this is coming in a couple of weeks. So right now FOX is only available on Ethereum mainnet. It's not much a problem anymore thanks to ETH price and gas now opening a position. It's pretty cheap, but it's been asked by the community, and Aladdin DAO is a community-centric DAO. So we're about to release FOX on Base to start with the same tradable assets, but we may be able to deliver higher leverage thanks to the chain speed and even add other tradable assets.
Very cool. Lots of stuff coming. I'm really looking forward to the yield-bearing stablecoin. I didn't realize you guys were doing that. That's amazing.
And it's, if not next week, the week after. So it's very soon.
Okay. You guys have a very strong development team. That's a lot of stuff. Very, very cool.
Yeah, there's always something cooking. It's tiring, but it's fascinating.
Cool. Cool. So to summarize, FFX, really good trading platform, leverage trading platform where you can trade without worrying about liquidations or even paying funding. So really good for long-term positions. And you can also farm on there. You can farm the stability pool. You can farm the liquidity pools. And the yield is quite good. Over 10% on stables is pretty great in this market environment. And how can people find out more about FFX? Where can they go to use the protocol or read about it or discuss it?
Sure. The best would be, if you want to try it, to use your referral code for sure. And I guess you put in the description, but make sure you also read the documentation so that you understand perfectly how it works. And then the best place, if you have any doubt, any questions, is to join the Aladdin DAO Discord and follow the FFX account, obviously. But in the Aladdin DAO Discord, there's chants in many different languages, and you will always find help from the team and from the community to make sure you understand how it works. And you said it's a good trading tool for long-term traders, but it's also great for short-term traders because it delivers up to 7x and still protects you from hard liquidations. So it's good for any traders, basically.
Awesome. Thank you so much, Cyrille. Yeah, thank you for your time.
Pleasure. It's a real pleasure. Thank you very much for having me, and happy to come back anytime to discuss any upcoming features.